President Trump considers opening 401ks to private equity investments. A risky move? Imagine a scenario where your retirement savings are invested in a high-risk, high-reward financial sector, potentially boosting your returns, but also putting your nest egg at risk. This is the reality that President Trump is considering as he weighs the possibility of encouraging retirement funds to invest in private equity, a sector that has been struggling to attract capital after shrinking for the first time in decades. But here's where it gets controversial. By allowing retirement plans to invest in private equity, Trump would be opening up these funds to riskier investments, potentially giving private equity a much-needed capital infusion. And this is the part most people miss. Private equity firms often use borrowed money to conduct transactions, which can be lucrative but also increases the risk of default. Investors are eager to get access to these funds, despite the risks, as they often offer higher returns than traditional public equity investments. However, the lack of transparency and liquidity in private equity investments can make it difficult for investors to track their returns and get their money back if needed. The private equity industry has been ailing in recent years, with assets managed by buyout firms shrinking by 2% from 2023 to 2024, according to a report by the Financial Times. This has led to concerns that the sector is fundamentally overvalued, with some estimates suggesting that private equity firms have taken in as much as $1.6 trillion more than they have paid out in recent years. By opening up private investments to retirement funds, the fear is that institutional investors and rich individuals will be able to exit the overvalued market just as less savvy investors are encouraged to move in. Defined contribution retirement funds, such as 401ks, have traditionally invested in publicly traded stocks and bonds, which are generally considered safer investments. However, the Secure 2.0 retirement law passed in 2022 increased catch-up contributions for older Americans, potentially giving them more money to invest in riskier assets like private equity. But is this a good idea? Should retirement funds be allowed to invest in private equity, potentially putting retirees' savings at risk? Or would this move provide a much-needed boost to the private equity sector and give investors a chance to earn higher returns? The answer is not clear-cut, and experts are divided on the issue. Some argue that investors should have as many choices as possible, while others caution against the regulatory and political minefield that such a move could create. As BlackRock CEO Larry Fink noted in his annual letter, "We're going to need better ways to boost portfolios. Private assets like real estate and infrastructure can lift returns and protect investors during market downturns." However, Axel Merck, president of Merck Investments, warned that it's very difficult for trustees to direct money to somewhat riskier investments. If there were to be broader access provided, it's something of a political minefield for those that design 401ks. The controversy surrounding private equity is not new, with the industry having secured numerous wins in Congress and the executive branch over the years. The carried interest tax loophole, which allows fund managers to treat their income as capital gains for tax purposes, is a notable example. This loophole has been widely criticized, with estimates suggesting it could be worth around $1 trillion. Trump recently floated getting rid of it, but eventually left it in place. The private equity industry also got a major boost from the Trump tax cuts, which included a new accounting standard for interest deductibility that is especially valuable to businesses paying for investments with borrowed money. As the debate over private equity and retirement funds continues, one thing is clear. The stakes are high, and the outcome could have significant implications for investors and the broader economy. So, what do you think? Should retirement funds be allowed to invest in private equity, or is this a recipe for disaster? Share your thoughts in the comments below. Private credit in 401ks, a safe investment? Centerbridge Insights. Private credit deserves a spot in your 401k, according to Centerbridge Partners. The firm's co-founder, Jeff Aronson, believes it's a secure investment choice, as long as investors understand what they're putting their money into. With $42 billion in assets under management, Centerbridge launched its private credit strategy back in 2007, joining the growing trend of alternative managers tapping into the 401k market. But is private credit really suitable for everyone's retirement savings? The debate is on, and we want to hear your thoughts. Private equity in your 401k, understanding the hidden risks challenges. Imagine waking up one day to find that your retirement savings have taken a drastic hit, all because of a high-risk investment in your 401k. This is the harsh reality that many Americans may face if private equity is introduced into their retirement portfolios. But here's the thing. President Trump believes that your 401k can handle the risks associated with private equity. On the surface, this may seem like a great opportunity for investors to reap high rewards, but scratch beneath the surface and you'll find a complex web of risks and benefits that could make or break your retirement plans. So what happens when private equity is thrown into the mix of traditionally regulated publicly traded securities in your 401k? The answer is not as straightforward as you might think. For years, 401ks have been limited to investing in highly regulated publicly traded securities, providing a sense of security and reliability for investors. However, with the introduction of private equity, the rules of the game are changing. Private equity is a high-stakes business with high highs and low lows, making it a risky addition to any retirement plan. But, as the saying goes, high risk, high reward, and some investors may be tempted by the potential for high returns. And this is the part that most people miss. The president's expected executive order could provide legal cover for fund managers who include private equity in your retirement portfolio, potentially paving the way for a new era of investment opportunities. But at what cost? The risks associated with private equity are real, and investors need to be aware of the potential pitfalls before diving in. So, what are the risks and benefits of private equity in your 401k? On one hand, private equity can provide investors with access to a wider range of investment opportunities, potentially leading to higher returns. On the other hand, the lack of regulation and transparency in the private equity industry can make it difficult for investors to know exactly what they're getting themselves into. And as we've seen time and time again, high-risk investments can quickly turn sour, leaving investors with significant losses. But here's where it gets controversial. Some argue that the introduction of private equity into 401ks is a necessary step towards providing investors with more investment options and potentially higher returns. Others, however, claim that it's a recipe for disaster, putting the retirement savings of millions of Americans as we navigate this uncharted territory. One thing is certain. Investors need to be aware of the potential risks and benefits associated with private equity in their 401ks. And as we consider the implications of this new investment opportunity, we have to ask ourselves, what's the real cost of pursuing high returns? And are we willing to pay the price? The debate is ongoing, and we want to hear from you. Do you think private equity has a place in your 401k? Or is it a risk too great to take? Share your thoughts in the comments below, and let's keep the conversation going.